Hey everyone, this is Al Backness here, Managing Director of Architecture and Platforms here at KINETIQ. Welcome back to our series on fabric planning, where we are taking you into the day in the life of an organization for their FP&A planning process within the solution. In this video, we are going to be talking all about debt planning and how that is reflecting on your balance sheet, cash flow, and income statement. But before I get into the contents of today's video, I want to take a step back and tell you a story about a client and the CFO and the finance leaders of that organization and the pain points they were facing. For this client, they had two issues. In situations where they had excess cash, they did not know whether or not it made sense to be able to model out decisions around using that cash for the business or taking on debt based on various different instruments that are out there and how that would impact their cash flows. And the second piece was when cash was below their desired thresholds, they would have to need to understand exactly when it would make sense to do short-term financing. With fabric planning and the concept of connected planning, where we're bringing various different teams and modules together to formulate our financial statements, this is now possible within one place. On here, for example, we can see our power table and planning sheets reflecting our various different loans across our various different scenarios we're planning, as well as what the impact looks like from an interest and debt perspective on our organization's liabilities and income statement for the balance sheet, and cash flow from financing and operating activities for the cash flow statement. As an example here, if I'm seeing that there is going to be a change within interest rates and we're reflecting 10% for this particular loan type, I can immediately save this change and see the impact on my planning sheet right here to see exactly how that changes my loan structure. So what this is doing right here is this is not only able to enter in our new assumptions, but we can immediately see as well that interest rate reflected on our various different loans that we have modified right within the planning sheet here. We can also simulate what debt would look like if we want to take on more debt and how that affects our interest values. Let's say, for example, we are seeing an opening balance loan of not 100,000 but 200,000 that we're projecting. We can immediately go ahead and add that value in right here to see how that reflects on our module. Not only that, but we can also show principal payment pay downs where they're needed. So as an example here, maybe we plan to pay down the loan within May of this year. We can go ahead and simulate that. I can go ahead and plan to have a principal pay down of 100,000 and immediately take out the need for us to pay additional interest payments on that particular loan as it's moving throughout the fiscal year. This was a major benefit that this client saw from having this flexibility to do short-term financing modules, as well as have the ability to simulate what that looks like over time for their organization right here and how that impacts cash flow. So we hope you enjoyed this video in this series. We look forward to seeing you on the next one. Thank you, and this is Alp signing out.